Good day, students. In the last session, we were looking at the cost allocation techniques, and we went through an example of the activity-based costing system where we allocated the fixed manufacturing overheads amongst two products. And how we allocated those, we could allocate them on a total basis and then divide it per unit to get to the total cost per unit of the fixed manufacturing overheads. But these costs, together with the direct material and direct labor, all formed part of the cost of goods sold, if you remember. I also then take you back to the first cost concepts session that we did when we were also looking at this ABC example where they sold handbags. And you would have noticed that these three costs here, direct material, direct labor, and overheads, all formed part of your cost of goods sold. So once you added up your direct material, your direct labor, and your overheads, and the overheads was just the full 900,000 divided by the units that you produced in that period to get to a per unit overhead cost, we got to a unit product cost of 900. If we multiplied that 900 then by the cost of goods sold, which were 2,600 in this case, this gave us then our cost of sales. But now what we're going to be doing today is we're not going to be looking at the manufacturing overhead specifically. We're going to be looking at costs in their entirety and how these costs behave. Costs can behave in three ways. You can have variable costs. These costs vary in proportion to the volume or activity or the production of units that you've come up with. So for an example of a variable cost, if we are paying a temporary laborer a wage per hour based on the units that he's producing, that will form part of a variable cost. If we're producing more units, we pay the temporary laborer a lot more wages. If we're producing less units, we also pay him less. Because his costs vary in direct proportion to the volume or the actual units produced, this actually tells us that that's a fixed cost. This contrasts with your fixed costs. How does it contrast? Fixed costs remain constant over a wide range of activity. If I were to think of an example for fixed cost, I can think of a factory supervisor who's a permanent staff member and who's on an employment contract where you've given him a cost to company per year. And regardless of the volumes or units you're producing within your factory, if you're paying, let's say, the factory supervisor that exact amount every year, regardless of the volumes, his cost will then be classified as a fixed cost. Even though in the following year you could potentially give him an increase, because it remains constant over that 12-month period, we can then classify it as a fixed cost. The last way in which a cost can behave, you can also get mixed costs. Mixed costs have both a fixed and a variable component. If I were to think of an example, the one that comes to mind is electricity. So for electricity, you could pay Eskom a fixed portion regardless of the units that you're producing. You will always pay that fixed portion maybe per month. And then you can also pay them based on the kilowatts. And if you produce more units, you use more electricity. So then there'll be a variable component to that electricity cost. But it will also still have that fixed portion that because you have access to that electricity line, you still have to pay that certain fixed cost. That's an example of a mixed cost. Why would we need to know how costs behave? In a management accounting, you can come up with two different types of income statements. You can come up with an absorption costing income statement, or you can come up with a variable costing income statement. How do these two vary? An absorption costing income statement is the one we've been learning and the one we've been doing all along. So if you look at a company's annual report, any company that you can pick up now and search for their annual report, and you were to look at the structure of the income statement, they are producing what is called an absorption costing income statement. What is the layout of an absorption income costing statement? Absorption, you have your normal sales, but now under cost of sales, you've included in all those cost of sales, you've included the direct material, you've included the direct labor, and you've included the fixed overheads. You've allocated these costs based on what was the costs incurred at the factory, based on what I was producing. And once you come up with a per unit cost, you then take this to the cost of goods sold, only take it to the cost of goods sold once it's sold. So what it does is all these costs will pile up into your inventory account, and the minute then the sale happens, it then goes through cost of goods sold. So if we were to look at this example that we did in the first session for costing, you'll notice that they did say that the company produced 3,000 handbags, but they only sold 2,600. Although we've come up with a unit product cost of 900, you'll notice here in the absorption costing method income statement, you take that 2,600, only the ones that were sold, you multiply it by that 900 unit product cost, you get to 2,340. Okay, your gross profit will then be 1.8 million. Okay, your operating expenses are the costs that have nothing to do with the factory and the production of these handbags, but these will include just your sales commission, your head office salaries, and your audit fees that we had gotten from the question. What does a variable costing income statement then try and do? The variable costing income statement wants to get the revenue, which is the same, both in an absorption and in a variable. But within this cost of goods sold, it doesn't want to create a cost of goods sold. It wants to create what is called less the variable costs. You want to split out here just the variable costs, and at the bottom here have all the fixed costs. I want to separate out at the top my variable costs, and towards the lower end, I want to put all my fixed costs together. Okay, how does that look like? If we were to do a variable costing income statement, the revenue was 2,600 times 1,620, which is the same for your absorption. But now you want to subtract your variable costs. If you looked at your direct material here, each time your material goes up, your units go up, you need more material to produce those handbags. The direct material is a variable cost, so we'll classify that as variable. That 375 times the units we've sold of 2,600, you'll get to that 975 here in the calculation. Okay, you do the same thing for direct labor. Your direct labor, you'll notice here it said it's made up of temporary laborers, and they paid 150 per hour, and they spend 90 minutes in making each handbag. So you're paying them a temporary cost, and they have to be making the handbag each time. So if the handbags are going up in terms of production, you are paying a lot more for the temporary laborers. Okay, our direct labor came to 225 per bag, and we sold 2,600 bags. So in this instance, our direct labor, if you looked at how I calculated it, was just the 2,600 times the 225. You'll get to that 585. Okay. Then you mustn't forget that although you had these two variable costs, there might have been other variable costs that didn't meet the definition of a factory per se cost, but we want to calculate all the variable costs and group them together at the top. So if we go down and say audit fees are not really variable, we're going to have to pay that regardless. So that makes is a fixed cost. Head office salaries, we're assuming that these head office guys are permanent employees, and you're paying them each 550 altogether. It does not say that they are paid based on making each bag. So that's not a variable, that's a fixed cost. But now it says the sales representative get commission only on the sales that are made. If I make more sales, I have to pay more commission. If I make less sales, I have to pay less commission. In that instance, your sales cost, commission, can be then classified as variable. So instead of here putting it under the operating or the period costs, you'll notice here in the absorption costing, we go and put our sales commission here as part of the variable costs of that same 421,200, and we get to a contribution margin of 2230,800. Okay, your gross profit margin, you got to a gross profit of 1872 versus your contribution margin is a lot higher of 2230,800. Okay, very different calculations. This one only must be variable. This one did have a portion of fixed. It just needed to be factory related costs or costs related to making the actual handbag. So that's how these two differ. Okay, let's now go to the fixed costs portion. If you looked at the fixed cost portion here, the fixed manufacturing overheads, you had 900,000 that you allocated amongst the 3,000 handbags. So you allocated 300 per bag. If you noticed here, you only sold 2,600 bags. So some of those 400 bags which are here were part of your unsold stock. How do I get to this 360,000? It is just the 900 times the bags that were not sold of 400. So a portion of that 900,000 has not been allocated fully to the cost of goods sold. Only 780 was allocated because you actually produced more than you sold. The only one that was sold of 2,600 went through the income statement. So 400 units remained unsold, and those had to then sit in your normal inventory account. How does this differ from your variable costing? Your variable costing here, you don't look at what were the units that were sold. Okay? If you've spent during that year 900,000 on fixed manufacturing overheads, the full 900,000 manufacturing overheads needs to come through, and you'll have the full 900,000 that you're allocating here, together with the audit fees and the head office salaries. And if we were to then calculate the profit before interest and tax, for the variable costing method, you get 230,800 versus the absorption costing method, which gave you 350,800. These two are different because of that 120,000 that is now still staying in inventory in the absorption method, whereas the variable cost, the full manufacturing overheads, had to come through. Okay, so what do I want to summarize here? Absorption costing and variable costing method. Absorption is the one you know. Okay, so normal revenue, cost of goods sold, and as part of the cost of sales, we've taught you how to now allocate to that cost of sales. You will have all the factory related costs in that cost of sales. Direct material, direct labor, together with the factory overheads. But that cost of goods sold needs to only relate to the sales that were sold during that period. Any other portion that was unsold needs to remain in the inventory account. You can't put that full cost through there. The other amount is sitting comfortably in inventory and will wait till it's sold. Whereas the variable costing income statement looked at revenue less variable costs, the full variable costs. We got to a contribution margin, and then we subtracted all the fixed costs incurred during that period. Okay? I'm not spitting out what's sitting in inventory and what was sold. The full amount of the costs are coming through in that way. Okay, that's how we distinguish between the two types, the absorption and the variable costing method. Thank you, guys. We'll now do part 2 in the next session.